Hi friends, I hope that all of you are in great preparation now for your November examination. One of the days I've just had a call from a CA final friend where he was reporting that illustration number 7 in chapter number 7 in volume 1 of financial reporting where he reported difficulty in understanding. So I thought through this lecture I would be in a position to drive home certain points which were not fully covered in our institute material. Now let us just have a look at the illustration number 7, volume number 1, chapter number 7 in ESOP, employee stock option. See, this problem is basically on cancellation settlement during vesting period. Let me read out for your convenience. The following particulars in respect of stock options granted by a company are available. Grant date on 1st of April 2006, number of employees covered being 300, number of options granted per employee 50, vesting period continuous employment of 4 years, nominal value per share is rupees 100, exercise price 125, and vesting period is 31st of March 2010, exercise date 31st of March 2011, and fair value of option per share on grant date is 12. The above stock option was cancelled on 31/3/2009, 3 years later, that is on payment of 1 rupee and 80 paisa per option, and was replaced by a new stock option granted on 1st of April 2009. The fair value of the cancelled option on 1st of April 2009 being 14 rupees and 55 paisa. The particulars of new stock option they are given from 1st of April 2009. Number of employees covered same 300. Number of option granted per employee is 60 now. So what was considered to be previously as 50 in the previous case, now it is 60. Vesting period, of course, from the date of change, they made it as 3 years instead of only 1 year. So just when it is to be lapsed or when it is to gain for 1 more year, then there is an extension that they made. Nominal value 100, and what happens regarding this excise price? Excise price got reduced. It is only favorable to employees. They need to pay 120 instead of 125. So therefore, such changes are expected to be recorded. Vesting period 31st of March 2012 and exchange period 31st of March 13, and fair value on the new grant date is 14 rupees and 75 paisa. There are no departures during the period. I mean, no employees have left during this period. Compute the amount of expense the company should recognize in each of the years from 2006-11 until 2011-12. It's not 10-12, 11-12, and show important accounts in the books of the company. So this problem would be requiring some amount of explanation and working. And now let us just show us how we can take them up. So firstly, let us understand that the company is in the position of a writer, because the company, the employees have got to pay the exercise price, but there is no premium the company would be collecting. So loss of income is expenditure for the company, that is employer. Loss of income is expenditure for the company. This item of expenditure shall be spread during the vesting period. So this is the background. Now let us just have a look at as how much is the expenditure in each of the periods we are going to take up. Out of the total 4 years, first 3 years we will take it up, because at the end of the third year there is a change that they wanted to make. So cumulative ratio, cumulative amount, then expenses recognized in each year. This is generally a format that would be very much easy for us to make a good presentation. Just closely follow. For the first year, we have taken up the number of employees covered being 300, and each one given with 50 shares option. And what we are expected to do is, so here it is at the rate of 50. So we can take up the number as 300 into 50, and the fair value is 15,000 into 12. And cumulative ratio, what is this cumulative ratio? In how many years we will take it up? By that point of time, you have just got only an year out of 4. So cumulative amount is nothing but 1,80,000 divided by 4. And how much we have got to recognize? Only that 45,000. So the next period 07, 08, same 300, same 15,000, and same fair value. But in this case, 2 years lapsed. So we are expected to consider 1,80,000 into 2 by 4. That comes to 90,000. How much is the expenditure that is to be recognized for this particular period? 90,000 minus 45,000. Let us proceed for the year 0809. Same 300, same 15,000, same 1,80,000. In this case, by now 3 by 4, and it is 1,80,000 into 3 divided by 4. That comes to 1,35,000, and 45,000 is the amount recognized during that period. How come 45,000 is 1,35,000 minus 90,000? So this amount of 12 applied on 15,000 comes to 1,80,000, which cannot be recognized as expenditure at the time of grant. It should be spread for the period of vesting. Period of vesting 4 years. So therefore we are trying to spread the expenditure to all the 4 years. That point of time they had a break. What sort of break? They want to cancel this option, and in that place a new option they want to place. And the party who is aggrieved in this particular arrangement is none other than the employees, and the employees are to be compensated. What is the amount of compensation they are provided with? They are provided with 1 rupee and 80 paisa per share. And apart from that, we know that fair value of option on the date of cancellation is 14.55. What it was 12 at the time of grant, now at the time of cancellation it is 14.55. Now, this is the fair value of the option which got started by 6/7. It is nothing to do with that 15 rupees and 75 paisa. So that 15 rupees and 75 paisa is for those options at the rate of 60 per employee, whereas this 12 rupees now had become 14 rupees and 55 paisa. So please understand that, and against which the company wanted to pay to the employees because they are breaking the contract. So agreed party should be compensated by the party who gained in the operation. Cash paid for cancellation 1 rupee and 80 paisa. Now the net fair value as in guidance note para number 27C I think so. So that comes to 14.55 minus 1.80. This is a net fair value as on the date of cancellation, and the fair value of option on the date of modification. This we are given in the problem as 15.75. So therefore, incremental fair value as on the date of cancellation and modification is 15.75 minus 12.75. So please just understand that this is incremental fair value and this is the fair value. So what will be the total value of option from the date of modification. Date of modification would be 15.75 plus 3. 15.75 for the future period and 3 rupees on account of change. So therefore, the entire operation, whatever we have just done, should be taken up the same way as we have done in this case. Instead of 12 rupees, it should be taken at 18 rupees and 75 paisa. So now, what we do is that for the future period, let us just bring out a same amount of working here. So here, what we do is that we take up 0, 9, 10, then 10, 11, 11, 12. Okay. Here, this will be changed from 50 to 60. And fair value, now it will be not at 12 rupees, but at 18.75. It was very clearly explained as how we have just got that number. Now, cumulative ratio is no longer 1 by 4. From now on, it is only 3 years. So, 1 by 3, 2 by 3, 3 by 3. And what is the cumulative amount? Divided by 3. Then, it is 2 by 3. Then, it is 3 by 3, the same number. So, expenses to be recognized in each one of those years being 1,12,500. Now, let us just see the computation regarding security premium as on the date of exercise. Exercise price received per share. No longer 125, it is 120. Value of service received. 15.75 was the value of the option on the date of modification. And because of the previous history of 3 rupees that we are going to add, so therefore value of the service rendered should be taken up at 18.75. Consideration received, one in the form of cash or likely to come in the form of cash 120 and the other one in the form of kind, that being the services 18.75. And this is the amount that we have received. And the nominal value being 100, so balance to be taken up as security premium. So this is what we are going to take up on the date of allotment. Now let us just see this scheme of journal entries since 6/7. So employees compensation account debit, credit ESOP outstanding. And this employees compensation account will be transferred to profit and loss account in each one of those years. This is for the first year. First year out of the 4 in the first lot. And then following year, same thing. Then 2 years gone. Then third year. So in this case, the amount to be taken up would be the balancing figure that is available at that point of time, where you got to recognize immediately. So we can't be just waiting for 1 more year, because that particular year will not be there at all, in the sense that they have gone in for cancellation of the old option. So therefore, whatever sum that is outstanding, that should be transferred to employees compensation account, profit and loss account debit, credit employees compensation 90,000. So since there is no future for that, and whatever that is remaining in that employees outstanding account, that should be taken up and recognized as expenditure for in the third year itself, including that of the fourth year. Had it been for all the 4 years, we would have taken up as 45,000 in each one of those years, whereas in the third year, we are accounting for third year as well as for the fourth year. Now, that 1 rupee and 80 paisa, what we have paid and which we have used to find out the net fair value, now it is an item of an adjustment towards employee stock option outstanding account. The journal entry what we got to pass is employee stock option outstanding account debit, that being 27,000, and credit is to be given for bank because it involves money. Then from now on, a new system will get into operation. You know that in each one of those years, now we'll take up 1,12,500. Like how we have done for 45,000, the same thing we would be doing. So now that security premium as how it had just come, we have already got it. Now we will pass a journal entry for that. So that excise price will be paid in the form of cash by the employees, bank account debit, employee stock option outstanding account, this would be the balancing figure at that point of time. When you prepare ledger accounts, you would know that. And share capital account, the nominal value, and credit security premium. So in our introduced study material, they have just given some solution, I would say, without proper backing or working. So therefore, students need not be just really worried about the mistakes that the institute had committed. Now that you know what is right, and please just make note of that. And all the best for your examination. Happy Diwali. Bye.